Welcome to SF Commercial Property Conversations with Bruce Bean, where Bay Area investments meet expert insights. Get ready to unlock the strategies of commercial real estate success.
So we've got today Venkat Avasarala with us. And Venkat, it's great to have you. I know you were born in Hyderabad in India, and in some way you got to the US, to Dallas of all places. So it'd be great to hear your origin story of how all that happened.
All right. So yeah, I came here back in 2002 after completing my bachelor's in electrical engineering to pursue my master's engineering. Because in India, there's just not a whole lot of opportunities, at least back then, 20 years ago, to apply yourself and to do above normal, right? I mean, the opportunities are far and few between. So that's why, that's one of the main reasons, like everybody comes here, you get access to the all latest technology, gadgets, and everything. So I couldn't believe it. As soon as I landed here and joined a university here, I get to design a chip. I have a software with my own hands.
Wow.
I designed the chip.
Wow.
And the university arranged the local chip fab company to make it for me and give it to me. So I get to test it. So I saw this whole thing in a million years. In 2002, I couldn't imagine that is possible. Just
Wow.
for somebody. So that's what US gives to you, right? I mean, that just pushes you forward so much, the learning, the journey, and that's why we come here, right? I mean, so I came here, completed the electrical engineering with the master's in electrical engineering with chip design, VLSI chip design. And then we were in the middle of recession at that time. So that is when Intel and all these big boys started sending jobs to India. Like India right now accounts for 20% of all the design work in high tech and chips and all that. 20%, just India. So all the jobs went to India. I came to here. I was like, what do I do?
No jobs.
Yeah, I mean, the entry-level jobs are all gone back then, right? Yeah. So I tried 6 months, and you know what? I got to do something. I got to eat too. So I took IT job thinking that, it's a short-term gig, but I loved it, what I was doing.
Oh, really?
And that became my career. So I ended up in IT. My very first job was with ADP in Jersey. Then I worked Halliburton in Houston. And then I went to T-Mobile in Seattle, and then finally landed in Dallas. So except for Midwest, I think I covered the four corners.
Right. Yeah, you saw it all.
And I got my training in Fremont, California. So yeah, been through everywhere and settled down in Dallas in 2006, bought a home and settled down, me and my wife. And then ever since I was in IT, started my real estate journey back in 2007, just before the recession, by foreclosures. I mean, we couldn't believe it. Like, that house is what, 60,000? I mean, it sold for like 200, 150.
Yeah, right.
We couldn't believe it, right? Yeah. So we just gorged upon it, and I myself bought like 20 homes, all using Fannie Freddie property. Every other month I was buying one. And then I got really scared in 2009-10 because I already paid less.
Oh, right.
Properties are worth a lot less than what I paid. And we couldn't think about it, like, what is happening, right? How could it be less than what I paid? So I took a pause, and 2012 is when I started, because 2011 we had a double dip recession under Obama. So 2012 is when it's over. Recession is over. It's all up. How do I know?
Yeah.
Because brokers stopped calling me. And I said, there's something is going on. Until then, they used to blow my phone. Oh, you want to buy home, that home, this home, and all that.
Yeah.
Then that is when I scaled up my portfolio all the way up to 20 homes, just me with my money, until 2015. And then I said, you know what? This doesn't work anymore. Do you know why? Because they don't pay more than 1% rent. Like, basically, I need to make 15% cash flow.
Right.
Month one. Not after 2 years and all that. In month one, I need to make 15% on the money I have invested. Otherwise, I won't write an offer. We were spoiled back those days. So that stopped happening in 2015. And I said, you know what? This is done. I mean, we're not going to do this no more. No. So then I went to apartments. And then, they're all 5 million, 6 million, 10 million, 20 million. I said, look, I don't have money just to put down on something like that. That is when I started syndicating. My very first property was in 100 units in Oklahoma City.
Oklahoma. Oh, yeah. Okay.
I live in Dallas, but nobody would trust me that I can raise money and close it. Because look, for brokers, it makes them look bad if I don't perform for whatsoever reason.
Right,
And the
right,
market
right.
is so hot back then in Dallas, and
Yeah.
so they don't want to take chance on somebody who never did anything in Dallas. So I had to go outside, prove myself, and come back in, or just wait for a miracle. I don't believe in miracles, so
Right. Yeah.
I
You
went
make
to
your own miracles. Yeah.
yeah. Oh, I went to Oklahoma property, bought a 1968 property or something, 100 units.
Yeah.
I paid like 3.5 million, ended up selling
Wow.
4.5 million or something.
Yeah.
First raise was 1.2 million. And then I did 120 units in Phoenix.
Oh, okay.
And Phoenix was still reeling. It's just recovering back then. Dallas was very hot in 2016, but Phoenix is like
Not
that.
there
That's why
yet.
they gave me the deal.
Uh-huh.
Then I showed all that, and the 2 months right after that, by February of 2017, I closed a property in Dallas, 306 units, 15 million
Wow.
dollars. So I bought three properties, a 3.5 million, I think how much I paid, like 7 million or something, Phoenix property, and a 15 million in under 8-9 months.
Wow.
So it was quick. And then in 2018, in 2016, I mean, the new president came along, started this bonus depreciation, this and that, and it got hot in a hurry. So what I had to do is like, look, there's just so many opportunities, and I got to go to. At the time, I was working at Bank of America.
Oh, really?
Yeah, and I'm
Right.
asking brokers to show me deals in the lunchtime, in the after five. And this is like, this is weird. We don't do that. I got to go home, spend time with my kids at 5 o'clock and not show you a property. and,
You
some,
don't have time for this. Yeah.
and some of this property, you don't want to go there after five, especially in the,
Yeah, right. Yeah. No, yeah.
So they didn't like it one bit. And they were like pissed every time I said that. And then I said, look, I think I got to make a decision. I want to keep my day 9 to 5 job, which I loved. All right. I mean, I did awesome stuff at Bank of America.
Yeah.
I loved the job, but can't keep it no more. Otherwise, I have to leave the opportunity. So I
Yeah.
went with the opportunity and then really scaled my business to 3,500 units at the
Wow.
peak. At the onset of COVID, I was holding 3,500 units, and these are all C-class properties. Life was good and all that. And then COVID rolled in, and 20% people start paying rent.
Oh, yeah, right.
And we were like crazy scared, right? And we were
Yeah,
scared.
yeah. Right.
And then they started money printers, and they printed
Yeah.
a whole lot of money.
Right. All the money
And,
came in, yeah.
and then money started flowing again. We feel good. But then again, we saw that these guys are stressed. They're not able to pay rent.
Right,
Government is
right.
paying rent and all that. And we asked ourselves, I used to have a partner. So we both asked ourselves, like, once at some point, government will cut them off, right? At some point,
Right.
they're not going to pay.
Right. It's
But
not
these
gonna
guys
last.
are worse off now because of the inflation, because of all this. Once the money stops, how are they going to pay rent? And the second thing is, why is insurance costing so much? Why is taxes jumping so
Oh,
much?
yeah. Right,
Why,
right.
why can't I rehab a unit for 5,000 units anymore? We saw a secular change from before to after COVID, like in a bad
yeah.
kind of change.
Construction
And then
got
we
very
extrapolated next 3-year numbers. Like we had 2018 data, 19 data, 20 data, and then in 21, February, we extrapolated how 21, 22, 23 looks like. We were scared on what we're going to look like 22.
Oh, wow.
And then we say, you know what, jump. Let's sell it all. Let's run.
Yeah.
And in September 2021, when everybody, and a bunch of my investors are angry at me, I said, are you crazy or do you listen to news? I mean, this is the time to buy more. This is, you know what, buy with somebody else, not with me,
Yeah.
So, that's fine. Even if you don't want to invest with me, that's fine. Because I did my math. I manage these properties. I write checks. I know what I'm doing. Right. So I saw like some $350 million portfolio. It's just built it over years, and then in one, they're all gone. And we made some decent money because see, one mistake we did. Now, see, the thing is this: our objective was to hold it for 10, 12 years. So we put 12-year debt on it. 12 years. With prepayment penalties and all that.
Yeah.
We didn't care. It was like, look, I mean, we're here. We want to keep this property. We want to enjoy this cash flow and all that, right? But then when I try to sell these properties, people don't want to assume those loans. And their interest rates are anywhere between 4.5% to 5.5%, that range.
Right. Yeah.
And they were like, look, I can get 3%. I can get 3.
You're right.
I don't want your loan. So we lost a bunch of money in, not lost, but our profit got decreased.
Yeah,
We had
right.
to pay the
Lower because
prepayment penalty.
you had to pay off your loans. Yeah.
Yes. But now that same loan, 4.5%, people will give a
Yeah,
kick.
they'd love that loan. They would
But
kill for
look,
that loan.
the yin yang, right? In 2021, it was a bad idea of putting a long-term debt. In 2022, it's the brilliant thing to do it. I mean, think about it, right? So that happened, and then I made a decision that I'm going to be careful from here on who I'm going to serve, right? Real estate is just a way to serve people. At some point, you have to do something for other people.
Right.
It's not magic that, we can make money out of thin air. So I said that, look, there are the top 20% of the people is who I want to serve because they either got a college degree or they have skills like maybe as a plumber or an HVAC guy, you can name his price or whatever, right? So they can keep up with this inflation, right? With all this money printing. We printed 50% more money from before to after COVID, right? In 2 years. Wow. We used to have $15 trillion money supply at the onset of COVID, and now we have 22 trillion. As of 2022. I'm not talking about 2025. In just those 2 years, we printed. That's why everybody's house is worth 50% more. That's it. Homes did not appreciate. It's the money.
Right. The money. Yeah.
So your dollar get deflated. So if you measure in gold bars, if your house is worth 10 gold bars before COVID, it's worth 10 gold bars after COVID. Yeah. If your house is worth 10 gold bars 20 years ago, it's exactly worth 10 gold bars today also. So the houses are not appreciating. It's the dollar which is depreciating, right?
Yeah.
So we need to serve those people who can go and get another job or whatever, or switch jobs to demand more pay so that they can pay me my rent and all the higher cost of living. Yeah. And if somebody is making $40,000, $50,000, I mean, they don't have that power. I mean, they cannot, for a brief period, maybe after COVID, as we come out of COVID, but not really, right? No. Anybody can do their job. They're unskilled and they don't have college degree. So that's the tenant in B and C class properties, or C mostly. That's profit in B. But class A tenant, they have college degree. They're going places, right? Those are the people I want to serve.
Yeah.
So that's why I moved on to Class A properties. But then again, if you buy existing properties, everything was trading like 5. Even today, like right now, nice properties to be had in Dallas, they're all sub 5. Negative leverage. Their interest rate is 5.5%, but they're paying 4.7. I don't know how to explain.
So they're making a cheap spread on the.
The thing is that they're going to keep it longer. Institutions buying these things. See, you buy anything for any price and you hold it long enough. Will come out okay. The problem is holding part.
So what's the demographic? So you're at the upper end. So what's the demographic of the person that wants a high-end apartment, but they haven't bought a house yet? How's that spread?
Yeah. So I moved to Dallas back in 2006. I used to make $80,000 a year. And you wouldn't believe we had so much surplus cash every month. We don't know what to spend on. Right? And this is after paying mortgage and all that, right? Me and my wife, we had so much money back in 2006. I mean, there's nothing to do here to blow money on, right? So then we started traveling to Europe, and I traveled, 32 countries and all that. So that was that, right?
Yeah.
Now, $80,000 is your median income. Well, I mean, forget about it. You can't live a decent life in North Dallas.
No, you
maybe South Dallas, maybe, right? But North Dallas, not really.
Right.
So I'm looking for the person who makes $80,000 to $120,000.
Okay.
It's good money, but not good enough to buy a home.
Right. So you're just under that. Yeah.
There you go. And also, these people can switch jobs if they ever falling back on their finances because they have marketable skills or degrees.
Yeah.
So these are the people, because look, I cannot control the money supply. They keep printing, and they're going to turn on the printers very soon now. Like they're trying to push the JP guy out, and they're going to print money again, and there will be asset inflation. Rent has to go up.
Yeah.
Because properties trade hands. As soon as they cut interest rates, all the pent-up demand, suddenly all the properties change hands. So let's say I'm selling my $80 million property to you for $100 million.
Right.
But you're not going to charge same rent what I charge. Your rents will be higher now.
Right, right,
because
right,
you
right.
just paid me $20 million
You
more
have
for
to
my
be higher.
property, right?
Yeah,
So
right.
rents will go up for restaurants, for people, everywhere, right?
Ah,
So I
wow.
need people who will be able to pay the future rents, not just today's rents,
Right,
future
right, right.
rents, so that they will be able to command 5, 6, 7% wage
Right,
growth year over
right.
year, one way or the other, right?
Yeah,
So those are the people I'm looking for. But that is good money, but not good enough to buy a home in North Dallas. Let's say everything starts at a half
right,
a million and up. Nobody
right.
builds the cheaper properties. All the
Yeah,
cheaper properties are nabbed up by investors and they won't let them go. I
yeah.
mean, you can, if you sell a property for 250K, built 15 years ago or something like that, you will
Right.
never be able to buy it back again. There is no such thing as a 250K entry level home.
So
Right.
how do you decide where to purchase a property to build on?
Yes. So I need obviously, I want to be close to the population centers. In
Ah,
Texas, we are a driving culture. If you are close to a highway, that's okay. 20 miles is 20 minutes.
yeah.
That's how we see it, right?
Okay,
Oh,
okay.
it's 20 miles. No, we don't see it that way. So you have to be close to a highway and you have
Yeah.
to be in a rich county and we
Oh,
need to be in a growing county. So
ah,
Texas, Dallas, Fort Worth is made up about 10 counties, four major ones and then six peripheral ones.
okay.
I invest in only four major counties and six peripheral. And the two counties that I invest in are Collin County, where Frisco is, Frisco,
Uh-huh.
and then Denton County. These are the two counties which are not only affluent, but growth is just those two counties take like half of all the population growth
Oh, wow.
and
Wow.
high income population growth. So
Wow.
that is where I want to be as well. And in these two counties, I have three large properties, 80 to $100 million each.
Oh,
So
yeah.
that's what I
Yeah.
do.
Yeah.
And these are and then the people who live here, they get to access all the employment opportunities. Their kids can go to this nice schools where rich
Schools.
people's
Yeah.
kids
Right.
goes,
Yeah.
right? And they get all the recreation and all that. And they are mostly close to highway. That's
Right.
the
Right. Right. So
so
they can
that's how
live
I
downtown.
decide where to build. And when I build, I want to build 300 units and above. Institutions don't like under 300. It's just not worth their time. If you build a 150 unit, they won't even open the OM. They don't
Wow.
care. Because
Wow.
if it's a 150 unit or 300 unit, you
Yeah.
still need to assign an asset manager. That guy still need to
Right.
spend same
Right.
exact amount of time. So
Yeah.
it's not there's no
Not worth it.
yeah. So that's why 300 units and about 3 to
Yeah.
350 is the sweet spot. And
Yeah.
I built these nice properties with a lot of parking, like
Right. Right.
1.6, no less than 1.6, 1.6 to 1, like
Yeah.
1.6 spots to one unit.
Because everybody's
And,
going to have two cars, basically, usually.
yeah, because we have a bunch of studios and all that, right? They only
Yeah.
have
Yeah.
like
One
one.
car. Yeah.
So we're gonna make sure that two bedrooms have two units, three bedrooms have three units, and one bedrooms and studios have one unit.
Oh, wow.
That's how
Yeah.
we plan it. And then nice amenity package, no cheap stuff. So we do that so that they are very desirable for institutions because
Ah,
institutions buy if it's a good product. See, cheap stuff are a dime a dozen. There's a lot of
right. Right. Right.
but
Right. Right.
nicer properties, especially when the money is cheaper,
Right. Right.
people will want that,
Oh, yeah.
so that's the thought process in building a nice property, all the amenity package, no crazy stuff, right? I mean, that's what we do.
The institutional guys can put a little more money up front too, so they don't have to take out as much loan, probably.
And they keep it long term.
Right.
See,
Right.
like our insurance costs are going through
Yeah.
the roof, right?
Oh,
How
yeah.
do they control the insurance, right? The float that they have, especially life costs.
Uh-huh.
They used to buy like back in 80s, they weren't buying any of this thing. They were investing in treasuries. They used to pay 10, 12%.
Right.
70s, 80s. But now, until recently, they paid like close to zero, right? So that's one of their profit center. So they take money from your whole insurance policy and
Yeah.
fix much of this cash in the assets which generate
Right.
premium.
Right.
And
Right.
that subsidizes the cost to you. That's how they can give all your money back after 30 years or whatever. So, but if they buy treasuries, that's not going to pay, right? The cost
No,
of
no,
insurance is
no,
getting
no.
higher. So they have to invest in these kind of properties. And what they do is it's just like a rental car companies, right? They buy
Yeah.
a brand new car, and as soon as you cross 32,000, they're going to sell it and be
Yeah.
out.
Get rid of
They don't
that
want to
car.
lose the warranty on it, right?
Right. Right.
Because
Right.
they don't want to do repairs and all that.
No. No.
That's exactly how the institutions think, right?
Wow.
They buy these stuff and they hold it for 10, no more than 15. After 15, you start
They go.
thinking about changing ACs, roofs.
Yeah. They
Yeah,
want,
they
no.
don't,
Forget
they
it.
don't
They're
want to
not.
deal with all that. So that's the kind of buyer I'm looking for.
It's just a used car to them. So Dallas, does Dallas still not have zoning regulations?
That's
Did you-
Houston. So
Oh,
that's
that's Houston.
Houston.
Oh,
Yeah,
okay.
Houston, anybody can build whatever, anybody.
Ah,
So in Texas, about a month ago, there was a bill that passed. It is not downright, there is no zoning, but you don't need multifamily zoning anymore.
oh,
If you
really?
have commercial zoning, like
Ah,
until yesterday it was office. Well, I mean, it
right.
doesn't have to be office anymore. By right, you can build multifamily there. Not that the cities will like it. They will make your life harder if you are trying
Right.
to build.
Right.
If a city, I mean, every city has a vision, right? I mean, they have a comprehensive
Right.
development plan. And
Yeah.
they saw that, okay, that corner is perfect for a retail center. That corner is perfect for office. Now,
Mhm.
I want to go there and say, I'm trying to pull the law on them and say, oh, well, look, I have by right, I can build a
Yeah.
multifamily. And they won't say no, but now they're gonna show who you're really dealing with, right? And they won't, right? But you can. So it'll be interesting. The law just passed, but it
See,
still has to be zone commercial. You cannot just flip
oh,
single
interesting.
land into
Yeah.
multi.
Yeah. So it's not like you have unlimited choices for where you can build.
See, that's the problem. I mean, Texas, we do have a supply problem. It's like
Ah,
a lot easier than building, like a lot easier than building in, let's say, Chicago or a Seattle or a
well,
California.
San
Um,
Francisco, impossible.
Yeah, like Frisco, I just I'm about to break ground on that one.
Oh, yeah.
The service that we got was like we felt like we were dealing with a private company, dealing with the city.
Oh, yeah.
Service level agreements and the tracking, like everybody on the app.
Wow.
Oh my
Ah,
God, yeah. I mean, you wouldn't expect these kind of thing from a government, but
no,
they
no,
work
no.
like
Right.
private.
Wow.
Yeah, so they're really good. So that makes it easier to build, and that's not a whole lot of, it's not a good thing. So that's why you got to build in affluent places, nice properties, so that you can set yourself apart from everybody else. You have to distinguish yourself, otherwise it's going to be an issue.
Well, and it sounds like it's working. So your investors like it. So what's the key factor if an investor wants to bail out early, what's the possibilities?
So that's the problem with these private placements, right? So I use Reg 506B because I don't
Yeah.
advertise, and most of my investors are IT, doctors, business owners,
Yeah.
all
Yeah.
accredited. I don't want to ask them to send bank statements and all that, because
Yeah.
if
Yeah.
you do
Right. Right.
506C, that's what you got to do. But then you can advertise, but I don't advertise. I don't need to.
Yeah.
I have enough people. I
Enough
raised
word of
$160
mouth.
million.
Yeah.
It's only word of mouth, and I do podcasts and all that. As you
Yeah.
saw, I enjoy these, right? I
Yeah.
mean, so,
Yeah.
but then, people who hear podcasts and all that, I mean, some people call me, but mostly it's word of mouth. That's
Yeah.
how I got my investors. But they cannot get out of this deal. It's
Right.
not like a
Right.
Google stock that they can sell tomorrow morning.
Yeah.
Now, in some extenuating circumstances, what we do is like we offer the shares to everybody else in the company to see if
Right.
somebody will step up and buy. But
Yeah.
that's contingent upon somebody having liquidity and the
Right.
deal performing at the peak at that time.
Yeah.
Just because you have liquidity, oh, you know what, man, the deal is not working well. Oh, you know what, let me buy other that guy's shares. No, who's going to do that? Nobody. The deal is really performing well. Okay, somebody's shares came available. You know what? I want them.
Yeah.
Right?
Yeah.
So it's very tentative. And we tell that to the investors, right? So
They know upfront.
not
Yeah.
invest money that you would be needing in the next
Yeah.
4
Right.
years or so. So
Right.
this takes time. But then again, look, they get to grow their money. Like unless somebody is really affluent, I personally never invested more than $50,000 in any stock, in one stock.
Right.
The thing is, like, what if it falls? I don't want to take 20% loss. So we
Right.
peanut butter across everybody else. But
Right.
these are something where you can stick in 100,000, 200,000, half a
Right.
million, right? And it's in one place. I don't have to do anything.
Right.
But then I can grow money over the long term better than what I do in stock market. Now, if you
And
compare it to Nvidia, oh, Nvidia got tripled in a year. You know,
yeah,
did
one
you
year.
put all
Yeah.
the money in there? Did you put $100,000 in Nvidia?
Right, right,
No,
right.
you wouldn't. You put
No.
20,000,
Yeah.
10,000. Look,
Right.
that part got tripled because nobody will ever have confidence to put a lot of money in one stock. The risk is always there,
Right, right.
right?
So, so how is so they can get out sort of if they want to, but do a lot of your investors roll over into the 1031 exchange or
We
what?
don't do 1031s and all that. The reason is this. If you do 1031, significant majority people have to
Yeah.
roll over. Otherwise, it's not worth it.
Ah,
Right. So what we do is like we do get long-term tax, and then
benefit. Yeah.
yeah, people get depreciation. People who invest with me, they have several other properties, not just with
Yeah.
me, with others also. I mean, this is what they do, right? I mean, with some of their money, so they
Yeah.
can shield capital gains from this. Look, all I say is like tax is an sh- tax should not be the primary thing.
Right, right, right.
That's when we
Yeah.
make mistakes.
Yeah, yeah, yeah.
You cannot put cart before horse. Look, we'll try our best to minimize tax, I mean, liability. We have a lot of time between now and then, right?
Right, right.
And we
A
are
lot of
doing long term
depreciation. Yeah.
anyway. And
Right.
we are doing long term anyway. Let's make money first, as safe as possible.
Yeah.
And then we'll figure
Yeah.
it out, right?
And you pay taxes if you pay taxes. Yeah. So,
But if you go, oh, you know what, I'm not going to pay taxes. And okay, oil, my God, you wouldn't believe that's the very first private placement I have done. So there's
yeah.
a company in Irving, Texas, near DFW airport. Somebody introduced me and they said that, Venkat, we're going to save you 80 cents on a dollar taxes. And they did on that particular year.
Oh, wow.
And I wrote my $50,000 check. It's a nice, shiny office in a beautiful big building and all the oil
Yeah.
offices and all that. And I
Yeah.
asked them that, look, okay, tax incentive is good, but what else will I get? I mean, how much I'm going to get?
Yeah. But
You
getting
you
any
can
return.
expect 15 to 20% a year perpetual cash flow. This is for 6 wells in North Dakota called bucket
Yeah.
shale.
Okay. In a opportunity zone.
And that's risky, right? I mean, but then
Yeah.
again,
Yeah. Yeah.
what they dangled in front of me is tax incentive. So I didn't see anything else because the juicy 80 cents on a dollar
Right.
tax
Right.
incentive is what I was looking for. And they won't let me forget it. And that was 2014. It's the 11th year. They still sends me like $3 to $4 every month. And over 11 years, I have received 4.5%. Over 11 years.
Not 15. Yeah.
No. You're combined 4.5%.
Oh,
That's
wow.
like 0.4%. So they were like BSing me, right? I mean, there's no 15% a year. Yeah. But look, I mean, that's my first one, and I never fell for taxes.
Never did it again.
Because I analyzed, it's like, why did this happen? How did I do this? I mean, I was a good investor. I had 20 homes. How did I fell for this? Tax.
Yeah. Right.
Tax savings. Oh, if anybody talks to me about tax savings first, I'll hang up the call. It's like, okay, they're selling snake oil.
I just did a podcast with a guy that was like drilling funds. That's the thing to do.
No. I'm not saying that all are bad. It's just that, see, when I build an apartment complex, you know how much I'm spending on that. You know what my
Right.
contingency budget is. You
Yeah.
know what rents are there. You can independently verify everything I'm telling you in my deck.
Right.
Oil,
Right.
how are you going to do that, right? I mean, how do you know how many gallons of
Yeah.
Nobody knows.
No, nobody knows. Yeah.
Nobody knows. We don't know how much oil price will be. I mean, rents, I can run a rent report. Oil, what report
Right.
will be sent?
Yeah. It's
What
not
report-
gonna, yeah, it's not
Yeah.
gonna fluctuate like the gas prices. So
Yeah, I don't mess with energy. I paid my dues. $50,000 is the tuition.
2014, that's it.
Yeah,
A
do
4%
not. I don't
return.
buy USO. I don't buy UNG. I don't buy energy stocks. It's volatile. It's super volatile. I'm not going to play that game.
What's,
I do some
what's
stuff.
your next project? What do you got coming up on the docket?
So this Frisco is a $100 million project,
Oh, okay.
315 units, and it's permit ready. I got
Frisco, California?
Texas,
No.
Texas.
Texas. Okay. Okay.
So
All right.
Frisco is where, like your Toyota,
Yeah.
they spent like what, 70, 80 years in Irvine, California. They got up and moved to Frisco border here.
Oh, wow.
Frisco.
Oh, really?
This is where all that things happen. Like
The action
PGA,
is.
like if you're into golf, the
Right.
PGA headquarters was for over 100 years in Jacksonville, Florida.
Right,
Guess
right,
where it is
right.
right now? It's in Frisco.
Oh, wow.
Right. So Frisco
Everybody.
is like our diamond for DFW. Like
Oh, my
it's
gosh.
our
Wow.
best. And I have in downtown Frisco, I have a site right next to FC Dallas Stadium,
Oh, wow.
soccer stadium.
Yeah,
Dan Hunt, the guy who owns Kansas City Chiefs, he owns the stadium right next to him. I have this parcel.
perfect.
I'm permit ready and I'm prepping. Oh my God, it's so hard herding cats and getting things done these days.
Yeah, oh, yeah.
See, the thing is this, I mean, there's lenders are far and few between.
Right,
Rents are
right.
still falling. They won't stop falling or they won't start growing until spring next year. So now, instead of 100 lenders, we have like 10.
Oh, wow.
And 4 will write the term sheet. 2 of them are serious, right? So now in this situation, you have this one lender that you want to keep him happy. And
Yeah.
and he wants to ask all these unconventional things. You know what? I want GC to sign a guarantee. Then GC looks at me like, why would I sign a guarantee? I'm a fee contractor, right? Oh, well, we want you to, right? So what do, right? You just make it happen.
Right.
Otherwise you don't get the deal done. So it's like pulling your own teeth. This
I
is the
assume
last
you
year.
have some incredible attorney that's working for you.
Oh yeah, I mean
Yeah, you got to.
And
Yeah.
oh my God, I refinanced a loan. It's about a $95 million loan. Sorry, $95 million property, about $70 million loan. Just like in April, I started the refinance process in July last year.
Oh, wow.
It took me 9 months to get that one done. It's just excruciatingly painful. I did a refi on my Colorado property, a $15 million property. I started in September last year. It's a simple refi, Freddie Mac.
Yeah, right.
So
Okay. Yeah.
it took from September to March. I closed that in March. It's the volatility. The interest rates are changing, rents are falling. This is
Everything.
a painful year. If you survive 2025 unscathed, you're gonna go play.
You're well, yeah, I just talked to a bankruptcy title insurance guy, and it's not pretty out there. So yeah.
I mean, we are at the peak, like we're at the peak pain level right now.
Right.
Right before they take the foot off our throat, this is maximum pressure they're applying right now. And if JP ends up in jail,
Right.
we're gonna get renegades,
Oh my God. All right. Well, we could talk for probably another couple weeks about this, but I think we'll pause for now. I want to see this Frisco property come out of the ground. So
absolutely.
I look forward to that. I want to keep in touch on that one. So
Absolutely.
All right. Well, very good to talk to you. I'm sure we'll be talking again very soon. So where can people get a hold of you, Venkat?
They can go to my website, like you see, strikerproperties.com.
Okay.
SRYKER properties.com. That way you can learn more about us, what we do, our projects, portfolio, and all that. And then there is a way for you guys to get in touch with me. Yeah.
Cool. All right. Well, let's be in touch.
That's a wrap on today's journey through the SF commercial real estate scene. Ready to share your story? Visit sfcommercialconversations.com/guest. Your insights could lead the next conversation.